There exists a peculiar stage in the evolution of a trader, a psychological plateau that has nothing to do with market knowledge, and everything to do with the architecture of human decision-making under uncertainty, where the trader knows what should be done but cannot bring himself to do it, where the intellect has been educated but the emotional system remains untamed, where strategy has been learned but character has not been forged. And it is here, in this invisible prison of the mind, that most trading careers either die slowly or transform into something unrecognizable from their original ambition. This is not the early phase of ignorance, when the newcomer fumbles with charts and indicators, searching for patterns in randomness with the innocent hope of someone who has not yet been broken by the market's indifference. Nor is it the advanced phase of mastery, when the trader has internalized risk management so completely that position sizing becomes automatic, when emotional responses to loss have been rewired through years of disciplined self-observation, when the ego's need to be right has been subordinated to the higher goal of capital preservation. The stuck phase exists between these two states, a purgatory of knowing without doing, of understanding without executing, of seeing the path forward but being unable to walk it because the psychological mechanisms that govern human behavior under conditions of uncertainty have not been properly recognized and reconfigured. In the 1970s, when Daniel Kahneman and Amos Tversky began their systematic investigation into how people make decisions involving risk and probability, they discovered something that would later explain why so many traders who possess adequate market knowledge still fail in their actual trading. Their prospect theory revealed that human beings do not evaluate potential gains and losses in an objective, mathematical manner, but rather through a deeply asymmetric psychological lens where losses loom approximately twice as large as equivalent gains. A loss of $100 creates a psychological impact roughly equivalent to the pleasure derived from a gain of $200. Fundamental asymmetry in how the human nervous system processes positive and negative outcomes creates a distortion in trading behavior that becomes most visible during the stuck phase, when the trader has learned enough to recognize profitable patterns, but has not yet developed the emotional discipline to act on them consistently. Consider the trader who enters a position based on a clearly defined setup, a pattern that his analysis has shown to offer a statistical edge over a series of trades. The position moves against him, not dramatically, but enough to trigger a small loss if he honors his predefined stop. He knows, intellectually, stop exists to protect his capital, that no single trade matters in the context of 100 trades, that losses are simply the cost of doing business in a probabilistic endeavor. Yet he does not exit. He watches the position move further into negative territory, and now the loss that should have been small and manageable has grown into something more substantial. The psychological pain of accepting this larger loss has intensified, and so he makes a decision that he knows is irrational. Even as he makes it, he will hold the position, giving it more room, more time. To close it now would be to accept a loss that has become too painful to bear. What began as a small deviation from his plan has now become a significant threat to his capital, and the mechanism that created this situation was not a lack of knowledge about risk management, but rather the way his nervous system processes the emotional weight of loss. Same trader, when he experiences a small profit on a position, often takes the opposite action. The position moves in his favor, reaching perhaps half of his intended profit target, and he feels a surge of satisfaction, a relief that this trade, at least, will not be a loss. The impulse to capture this profit becomes overwhelming, not because his analysis suggests the move has exhausted itself, but because the emotional system craves the certainty of a realized gain over the uncertainty of waiting for a larger profit that might disappear. He exits the position, a small profit, and feels momentarily vindicated in his trading ability. The asymmetry revealed by prospect theory is now operating in both directions. He holds losers too long because the pain of accepting a loss grows with the size of the loss, and he cuts winners too short because the pleasure of capturing a certain gain outweighs the potential pleasure of a larger but uncertain gain. This pattern, repeated across dozens or hundreds of trades, creates a mathematical certainty of failure regardless of the trader's ability to identify profitable setups. His average loss systematically exceeds his average gain. The trader who remains stuck in this phase often attributes his difficulties to external factors. The market was particularly volatile that day, the news event was unpredictable, the setup almost worked but just needed more time. Not yet recognized that the problem resides not in the market's behavior, but in his own psychological response to uncertainty and loss. The market itself is simply a stream of price information, neither hostile nor benevolent, following patterns of supply and demand that have nothing to do with any individual trader's emotional needs. But the human mind evolved in an environment where threats were concrete and immediate, where a loss of resources could mean starvation and a gain could mean survival, processes these abstract financial outcomes as if they carried the same existential weight. Category error in perception creates the systematic behavioral errors that define the stuck phase. In their extensive research on individual investor behavior, Brad Barber and Terence Odean analyzed trading records across thousands of retail accounts, documenting patterns that illuminated the psychological mechanisms operating beneath conscious awareness. They found that traders who traded most frequently achieved the lowest returns, not because they lacked market knowledge or access to information, because excessive trading generated costs that exceeded any edge their analysis might have provided, and more fundamentally, the impulse to trade frequently arose from psychological needs rather than from genuine market opportunities. Traders stuck in this phase often experiences trading not as a disciplined execution of a probabilistic edge, but as a psychological compulsion, a way of engaging with the market that satisfies deeper emotional needs for activity, control, or validation. When a trader experiences a loss, particularly a loss that violates his self-image as someone who understands the market, the psychological discomfort creates a powerful motivation to take another trade, to prove that the loss was an aberration, that his understanding is sound, that he is, in fact, a capable trader. Next trade is not taken because a high probability setup has emerged, but because the ego requires reassurance. The trader sees patterns in the market that are not there, or he trades setups that do not meet his own criteria because the psychological need to be proven right has overwhelmed the intellectual understanding of probability and edge. Barber and Odean's research showed that men, perhaps because of socialization patterns that encourage confidence and discourage admission of error, tended to trade more frequently than women and achieved correspondingly worse results, suggesting that overconfidence in one's ability to predict market movements is not a marker of skill, but rather a psychological liability that leads to excessive trading and diminished returns. Phenomenon becomes even more pronounced in environments where trading is most active and where the feedback loop between decision and outcome is most rapid. Conducted by Cheig, Di Losso, and Giovanetti examining Brazilian day traders over a 5-year period, revealed that 97% of individuals who engaged in day trading for more than 300 days lost money, and that the small percentage who did achieve profits earned less, on average, than they would have earned in a minimum wage job once the time invested was accounted for. This is not a statement about the impossibility of profitable trading, but rather a documentation of what happens when individuals engage in trading with insufficient psychological preparation, when the stuck phase is never transcended, when the patterns of behavior driven by loss aversion, overconfidence, and the need for validation are never identified and corrected. The day trader who remains stuck believes that more activity will lead to better results, that more screen time will reveal patterns others have missed. Sheer effort and persistence will overcome the psychological obstacles that prevent consistent execution. He sits before his screens for hours, taking trade after trade, experiencing the emotional roller coaster of small wins and larger losses, never pausing to examine the psychological patterns that govern his decisions. Each loss reinforces the need to take another trade to recover. Each win creates a sense of invincibility that leads to larger position sizes or lower quality setups. And the cycle continues until either the account is depleted or some external intervention forces a pause in the activity. The market, indifferent to this drama, continues to move in patterns that can be understood and exploited by those who have transcended the stuck phase. But for the trader trapped within it, no amount of market knowledge will translate into consistent profitability because the execution problem has not been addressed. Mark Douglas, Examination of Trading Psychology, identified a core issue that defines the stuck phase. Traders who fail are those who have not accepted the fundamental uncertainty inherent in trading, who are seeking certainty in an environment where certainty does not exist, who are trying to be right about individual trades rather than thinking in terms of probabilities across a series of trades. Trader stuck in this phase attaches tremendous emotional significance to each individual trade outcome. If the trade wins, he feels validated, intelligent, capable. The trade loses, he feels the opposite, emotional valence attached to random outcomes in a probabilistic system creates a psychological environment where rational decision making becomes impossible. Consider the trader who has developed a system that wins 55% of the time with favorable risk-reward ratios, statistical edge that would generate substantial profits if executed consistently over a large sample. He begins trading this system, and the first 3 trades are losers. Intellectually, he understands that a 55% win rate means that 45% of trades will lose. 3 consecutive losses is not only possible, but statistically expected to occur regularly. Emotionally, however, 3 losses feel like a referendum on his competence. He begins to question the system, to wonder if the edge has disappeared, to search for what went wrong with his analysis. The 4th setup appears, meeting all the criteria of his system, but now he hesitates. The emotional pain of 3 consecutive losses has created a fear of experiencing a 4th, and so he either skips the trade entirely or reduces his position size dramatically. 4th trade, which he did not take or took in a diminished form, proceeds to be a substantial winner. Now he experiences a different psychological pain, the regret of missing a profitable trade, the anger at himself for not following his system. 5th setup appears, and now, driven by the need to recover the opportunity he missed, he takes the trade with an oversized position, or perhaps he takes it even though it does not quite meet his criteria, because the emotional need to capture the next winner has overwhelmed his discipline. This trade loses, magnified by the oversized position, creates even more psychological damage. This cycle, questioning the system after losses, hesitating on the next setup, overtrading or revenge trading to make up for missed opportunities, is the behavioral signature of the stuck phase. The trader possesses a methodology that would work if executed with emotional neutrality, but emotional neutrality is precisely what he lacks. Each trade outcome affects the next trading decision, not through any rational updating of probabilities based on new information, through the emotional residue that clouds judgment and distorts risk perception. Douglas emphasized that the path out of this trap requires a fundamental shift in how the trader relates to uncertainty. Rather than seeking to be right about individual trades, trader must accept that any individual trade is essentially a random outcome, that edge expresses itself only across a series of trades, that the goal is not to predict which trades will win, but to execute the methodology with perfect consistency, and allow the probabilities to work themselves out over time. This acceptance of uncertainty is not an intellectual exercise, but a deep emotional transformation. It requires the trader to relinquish the ego's need to be proven right, to release the illusion of control that makes trading psychologically satisfying, but practically destructive. The trader in the stuck phase often clings to the belief that with sufficient analysis, with the right indicator, with more study, he will be able to predict market movements with high certainty. This belief serves an important psychological function. It maintains the sense of potential control, suggests that losses are simply the result of insufficient knowledge rather than inherent randomness, protects the ego from the uncomfortable truth that even with perfect analysis, a substantial percentage of trades will lose. But this belief is the very thing that keeps the trader stuck. It prevents the necessary acceptance of uncertainty that would allow for consistent execution without emotional interference. Van Tharp's research into trader psychology and methodology emphasized that beliefs about markets, about self, and about trading itself create the psychological framework within which all trading decisions are made. A trader who believes that the market owes him a profit, that his analysis should be rewarded, that losses indicate personal failure, will make systematically different decisions than a trader who believes that the market is neutral. Losses are simply feedback about what did not work, that long-term profitability comes from consistent execution of an edge. These beliefs operate largely outside of conscious awareness, shaping perception and decision, making in ways the trader himself may not recognize. The trader stuck in this phase has often absorbed beliefs about trading from popular culture, from social media, from stories of legendary traders that emphasize the importance of being right, of making bold predictions, of having conviction in one's analysis. Beliefs are incompatible with the actual psychological requirements of profitable trading, which emphasize humility, acceptance of ignorance, and strict adherence to risk management regardless of how certain one feels about a trade. Tharp's work on position sizing revealed that many traders fail not because their market analysis is flawed, but because they risk too much capital on individual trades, allowing a normal run of losses to deplete the account to the point where recovery becomes mathematically difficult or psychologically impossible. The trader in the stuck phase often sizes positions based on emotional factors rather than mathematical ones. After a loss, he may reduce position size out of fear. After a win, he may increase position size out of confidence. Neither decision is based on the statistical properties of the trading system or on the appropriate relationship between account size and risk per trade. Emotionally driven position sizing creates a random walk in account equity that has nothing to do with the quality of the setups being traded and everything to do with the psychological state of the trader. Consider a trader with a $10,000 account who typically risks 1% per trade, $100. His system triggers a setup, he enters the position with appropriate size, and the trade loses. He feels the sting of the loss more acutely than he rationally should, and so on the next trade, even though it meets all his criteria, he reduces his risk to $50, 0.5% of his account, because he wants to protect himself from another full loss. Trade wins, but because he reduced his size, the gain is only $50, half of what it should have been. Now he experiences regret for not taking full size, and when the next setup appears, he increases to a 1.5% risk, $150, attempting to make up for the opportunity he partially missed. Trade loses, costing him $150, more than the standard loss. Over a series of trades where his system might have a genuine edge, his emotional position sizing has created a random relationship between the quality of the setup and the amount of capital risk, virtually guaranteeing that the mathematical edge will not translate into account growth. The stuck phase, then, is characterized by knowledge without execution, understanding without implementation, strategy without discipline. The trader knows he should cut losses short. He does not do it. He knows he should let winners run, not do it. He knows he should trade only his best setups. He does not do it. The gap between knowing and doing is not an informational gap, but a psychological one, and no amount of additional market education will close it. What is required is a different kind of work entirely. Systematic examination of one's own psychological patterns, the identification of the specific emotional triggers that lead to trading errors, development of practices that allow for emotional regulation under conditions of uncertainty and financial risk. Brett Steenbarger's research into trader development emphasized the critical importance of self-observation and process-focused improvement. He found that successful traders maintained detailed journals not merely of their trades, but of their psychological state before, during, and after trades, of the specific thoughts and emotions that accompanied trading decisions, of the patterns that emerged when trades were reviewed in aggregate. Practice of rigorous self-examination serves multiple functions. It creates a record that allows the trader to identify patterns he cannot see in the moment. It forces a pause between the emotional impulse and the trading action, inserting a moment of reflection that can interrupt automatic behavioral patterns. Shifts attention from outcome to process, from whether a trade made money to whether the trade was executed according to plan, whether the psychological state was one of discipline or compulsion, whether the decision-making process was sound regardless of the result. Trader who remains stuck typically does not engage in this kind of systematic self-review. He may keep a record of trades for tax purposes or for general tracking, but he does not examine the psychological dimension of his trading. After a losing trade, he moves quickly to the next opportunity, seeking to recover the loss or to avoid the discomfort of examining what went wrong. After a winning trade, he feels vindicated and sees no need for analysis. The wins and losses blur together into an emotional narrative where he is sometimes right and sometimes wrong, sometimes disciplined and sometimes not, with no clear pattern because no effort has been made to identify patterns. Steenbarger emphasized that expert performance in any domain, including trading, comes from what he called deliberate practice-focused, effortful work on specific weaknesses, guided by immediate feedback and constant adjustment. Trader in the stuck phase is not engaged in deliberate practice, but in what might be called active repetition, doing the same things over and over, experiencing the same emotional patterns, making the same errors, without the systematic analysis that would allow for improvement. Psychological research on price levels conducted by Lucy and O'Connor revealed that traders attach emotional significance to round numbers and previous price levels in ways that affect their trading decisions. A stock that has fallen from $50 to $45 carries, for many traders, the psychological weight of having been worth $50, and there exists an irrational hope that it will return to that level. Is not based on any analysis of the company's fundamentals or the technical structure of the chart, but on the psychological comfort of round numbers and the idea of prices returning to where they once were. Traders stuck in this phase may hold a losing position precisely because the stock was once at a higher price, as if the market has some obligation to restore it to that level, as if past prices have some magnetic pull on future prices. This is a form of magical thinking, a cognitive distortion where the mind imposes order and meaning on random fluctuations, and it leads to holding losers far beyond any rational stop point, because the psychological narrative has become more powerful than the actual price action. Similarly, when a stock reaches a round number like 50 or 100, traders often experience the psychological pull to take profits, not because the technical or fundamental picture has changed, but because the round number feels like a destination, a place where taking action is appropriate. The market itself does not care about round numbers except to the extent that enough traders care about them to create temporary supply or demand imbalances. But for the individual trader stuck in the psychological phase, these numbers become emotional landmarks that trigger trading decisions divorced from any systematic methodology. The stuck phase is also characterized by a particular relationship to the trading plan itself. The trader has usually, by this point, developed or adopted some kind of methodology. Perhaps it is a set of technical criteria for entries and exits, or a fundamental approach to valuing securities, or a systematic strategy based on quantitative analysis. On paper, this plan may be sound. It may reflect genuine market research, careful backtesting, and risk management principles. But in actual trading, the plan is violated with disturbing regularity. The trader sees a setup that almost meets his criteria, and he talks himself into taking it, because it seems close enough, because he has a feeling about it, because he does not want to miss the move. Or he sees his primary setup, but hesitates because the market context makes him nervous, and he skips a trade that perfectly matched his system. Or he enters a position according to plan but exits prematurely because he cannot tolerate the normal fluctuation that occurs before a setup reaches its profit target. Deviations from the plan are not random mistakes, but systematic psychological patterns. The trader violates his plan when his emotional needs conflict with what the plan requires. He needs to feel active and engaged. He takes marginal setups that do not meet his criteria. He needs to avoid the pain of a loss, so he exits before his stop is hit or holds beyond his stop hoping for a reversal. He needs to feel the security of a locked-in profit. He exits winning trades before they reach his targets. Each violation makes rational sense in the moment from the perspective of emotional regulation. It reduces anxiety, creates a sense of control, provides immediate relief from discomfort. But across a series of trades, emotionally rational decisions create economically irrational results. The plan that might have worked is never actually tested because it is never actually followed with consistency. What makes the stuck phase particularly insidious is that the trader often experiences intermittent reinforcement of his undisciplined behavior. He takes a trade that does not meet his criteria, and it wins. Win feels like validation of his intuition, of his ability to read the market beyond the rigid confines of his system. He holds a position past his stop, and it eventually reverses and becomes a winner. This outcome reinforces the behavior of not honoring stops, of giving positions more room. Even though over a large sample, behavior will be catastrophically destructive. The intermittent reinforcement, the occasional win that comes from violating the plan, one of the most powerful psychological mechanisms for maintaining behavior, as demonstrated in decades of research on learning and conditioning. The trader becomes, in effect, conditioned to his own undisciplined behavior by the occasional reward it provides, and this makes changing the behavior extraordinarily difficult without deliberate, systematic intervention. The path out of the stuck phase does not lie in finding a better trading system or in acquiring more market knowledge. The trader who has reached this phase typically already knows enough about markets to be profitable if he could execute consistently. The problem is not informational but characterological. It requires a transformation not in what the trader knows but in how he relates to uncertainty, to loss, to his own ego, to the emotional experience of trading. This transformation cannot be achieved through reading alone, though reading can provide a framework for understanding what needs to change. It requires practice, repetition, self-observation, and a willingness to confront uncomfortable truths about one's own psychological patterns. Trader must begin to keep a detailed record not merely of trades, but of the psychological context surrounding trades. Before entering a position, he might note his emotional state, his level of confidence, whether the setup meets his criteria fully or only partially, whether he is trading according to plan or deviating from it. During the trade, he might note the thoughts and feelings that arise, the impulse to exit early or to move the stop, the anxiety or excitement that accompanies price fluctuations. After the trade closes, he reviews not just whether it made money, but whether he executed it according to his process, whether he allowed his emotions to influence his decisions, whether there are patterns emerging across multiple trades. This practice is tedious and uncomfortable. It forces the trader to confront his own weaknesses and inconsistencies. It is precisely this confrontation that begins to create the psychological shift necessary for consistent execution. Over time, patterns emerge from this record. The trader notices that he tends to violate his stops most frequently after a series of small wins, when confidence has become overconfidence, or that he hesitates to take trades after a string of losses, when fear has overtaken rational assessment of probability, or that he sizes positions based on his emotional need for action rather than on the mathematical relationship between account size and appropriate risk. These patterns, once identified, can be addressed through specific interventions. If the pattern is overconfidence after wins, trader might implement a rule that requires reducing position size or taking a break after 3 consecutive winning trades. The pattern is fear-based hesitation after losses. He might commit to taking every setup that meets his criteria regardless of recent results, focusing on execution rather than outcome. If the pattern is emotional position sizing, he might automate the calculation so that position size is determined by a formula rather than by feeling. The transformation also requires a fundamental shift in what the trader defines as success. In the stuck phase, success is defined by winning trades, by being right, by making money on individual positions. This definition creates the psychological conditions that make consistent execution impossible, because it attaches the trader's sense of competence and self-worth to outcomes that are, in any single instance, substantially random. The trader must learn to define success instead as perfect execution of his process, as adherence to his plan regardless of outcome, as emotional neutrality in the face of wins and losses. A trade that loses money but was executed perfectly according to plan is a success. Trade that makes money but was taken impulsively or with improper size is a failure. This redefinition of success is counterintuitive and emotionally difficult. It requires relinquishing the immediate gratification of winning and accepting the delayed gratification of process improvement. But it is essential. It is the only definition of success that the trader can actually control. He cannot control whether any individual trade wins or loses. He can control whether he executes his plan with discipline. This process of transformation is neither quick nor linear. The trader may have periods of improved discipline followed by relapses into old patterns, particularly during periods of stress or after unusual market conditions. Psychological patterns that created the stuck phase were formed over years, reinforced by hundreds of trading experiences, and they will not disappear simply because the trader has intellectual insight into them. What is required is the patient, consistent work of rewiring automatic responses, of building new neural pathways through repetition of disciplined behavior, of gradually reducing the emotional charge attached to winning and losing. Some traders never complete this transformation. They remain stuck for years, cycling through periods of hope and despair, of discipline and abandon, never quite understanding that the problem is not out there in the market, but in here in their own psychological responses. The traders who do emerge from the stuck phase often describe the experience as a kind of death and rebirth. The death of the ego's need to be right, the death of the fantasy of control, the death of the emotional relationship to money that made each fluctuation in account value feel like a referendum on personal worth, and the birth of a different kind of trader, one who approaches markets with humility, who understands that his edge is statistical rather than predictive, who can execute his methodology with emotional neutrality because he has accepted the fundamental uncertainty that defines trading. Transformed trader still experiences the emotions that come with risk and uncertainty, the anxiety of an open position, the disappointment of a loss, satisfaction of a win, but these emotions do not control his decisions. They are observed, noted, allowed to pass, while the process of trading continues according to plan. The market, in its essential nature, is simply information. Prices moving up and down, responding to the aggregated decisions of millions of participants, following patterns that emerge from the interplay of supply and demand, fear and greed, information and speculation. The market has no opinion about any individual trader, not care whether he succeeds or fails. It does not reward hard work or punish laziness. It simply presents opportunities to those who can perceive them and execute on them with discipline. The trader in the stuck phase experiences the market as an adversary, as something that takes his money, that moves against him specifically, that seems to know when he enters a position so it can move in the opposite direction. Is magical thinking, a cognitive distortion that assigns intention and agency to random fluctuations. The market is not the enemy. The market is not the problem. The market is simply the environment in which the trading occurs. The enemy, if such a word must be used, is the trader's own mind in its undisciplined state. The psychological mechanisms that made sense in the evolutionary environment where they developed, the fear of loss, the desire for certainty, the need for validation, the impulse toward immediate gratification, become liabilities in the context of trading, where success requires accepting uncertainty, deferring gratification, maintaining discipline in the face of fear, and executing a process regardless of whether it feels comfortable. Trader who remains stuck is at war not with the market, but with himself, with the automatic patterns of thought and feeling that arise in response to uncertainty and risk. Until this internal conflict is recognized and addressed, no amount of market knowledge will translate into consistent profitability. The stuck phase, then, best understood not as a stage that traders pass through automatically with sufficient experience, but as a test of character, a psychological crucible that reveals whether the individual has the capacity for the kind of self-examination and behavioral change that profitable trading requires. Some pass through relatively quickly, either because they possess unusual emotional discipline from the start, or because they are willing to do the uncomfortable work of examining and changing their psychological patterns. Others remain stuck for years, trapped by their own unwillingness to confront the truth that the problem is internal rather than external. And still others never escape, eventually abandoning trading entirely, often with the mistaken belief that they lacked the intellectual capacity or the right system, never understanding that they possessed both but lacked the psychological development to make use of them. The transformation from stuck to consistent is not glamorous, not make for compelling stories of sudden insight or dramatic turnarounds. It is a gradual, painstaking process of building new habits, of rewiring automatic responses, of learning to tolerate the discomfort of uncertainty without seeking relief through undisciplined action. It happens in the quiet moments of self-reflection, in the decision to honor a stop, even when every fiber of one's being wants to give the position more room, in the choice to skip a marginal setup, even when the emotional need for action is overwhelming, in the consistent execution of a plan through periods of drawdown when confidence is shaken and doubt is pervasive. These small, unglamorous acts of discipline, repeated thousands of times across months and years, are what separate those who eventually become consistently profitable from those who remain perpetually stuck, cycling through the same emotional patterns, making the same errors, hoping that somehow the results will change without fundamental change in their own behavior. The market will continue to move, indifferent to the struggles of individual traders, creating opportunities for those who can perceive them and execute on them with discipline, destroying the capital of those who cannot. The stuck phase is not imposed by the market, but created by the trader's own psychological patterns, and therefore the solution must come from within. The trader must become his own psychologist, his own coach, his own most honest critic. He must learn to observe his own mind with the same detached curiosity he brings to observing price charts, to identify the patterns in his own behavior with the same rigor he applies to identifying patterns in the market, change his own automatic responses with the same patience required to wait for high probability setups. This is the real work of trading, and it is work that cannot be avoided or outsourced. Either the trader develops the psychological capacity to execute consistently, or he remains stuck. He leaves the market entirely. There is no fourth option, no shortcut, no system or indicator or piece of market knowledge that can substitute for this fundamental psychological development. The market is not the enemy. Trader's own undisciplined mind is the only obstacle between where he is and where he needs to be.